Hello everyone, today is Friday, February 25th, 2022. My name is Evan. Welcome back to our weekly stock market analysis series. If it's your first time tuning in, thanks for joining us. Thanks for being here. Here's how these videos work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets. We go beyond price action and we look at things like correlation and the term structure of volatility, credit markets, interest rates, all the good stuff, pick apart things that look interesting, different, notable. And then in part two, we jump into the charts. We look at those longer term trends, try and make sense of the action and where we might be going. So hopefully that sounds good to you. Let's jump into some of the headlines from this week. Obviously, the big and sad story from this week is we had the Russian invasion of Ukraine. My thoughts, our thoughts here at Trade Risk go out to everyone that has been affected. There's lots of good people over there, and I hope everyone listening to this is safe and out of harm's way. So thoughts definitely go out to everyone that is affected. That said, you know, we do run a market analysis series here, and it is our job to sort of make sense of price action and to think about market movement. And when we look at the reaction here to these events, we saw equity markets initially knee-jerk sort of sell off and seemingly capitulate in this recent down leg here. So we saw that initial leg lower followed by a rally throughout the Thursday session and a follow-through session higher on Friday. So what that left us with was equity markets closing at their weekly highs. We saw reversals really broad across the board, high volume, outside reversals, and one of sort of the themes, or the even I think it was maybe the title of the episode last week, was that everything was so bad that maybe it's a buy signal, right? Like that was essentially the high level thinking. Is when we went through all the data last week, everything right down the list just looked horrible. And we you know, basically had this scenario where, you know, from a trending perspective, this might not be the market you want to be an investor in. But I mean, if you're looking for opportunity, if you're more tactical, right, when there's so much that is negative out there and all the technicians are looking at all these bearish things, well, maybe we're at some type of short-term low. Of course, now with the events here of a war or an invasion, you know, we have we have really, again, just more bad, right? Even more bad, right? What's worse than, you know, seeing some of these events now take fold, and there you sort of have, you know, the markets really doing what they do best, is fooling the majority and you know, sadly rallying off of this horrible news. So that's kind of the way this ultimately unfolded here. We're going to talk more about that a little bit later. We also notably saw some big reversals in the high yield credit markets, and I think that's notable. I know a lot of folks may not look at these markets, but that was good to see as well. So let's take a look at some of the numbers here. 1 week column right hand, you can see we had mostly green, so the Dow Jones ended up closing flat. It was still at the high of the week, or is down just slightly. S&P was up almost 1%, Nasdaq up a little over 1%. Russell 2000 led us to the upside 1.5%. Take a look at the 1 month numbers. We talked about this last week as well, but the Russell 2000 here was the first to sell off, and it seems to be the first to now start to stabilize here on the sort of after effect or on the other side. So this is notable here. Russell 2000 continues to outperform. World stocks were doing really well, outperforming as well. They are still holding up decent on a 1 month basis, but they certainly took a hit today looking at the ACWX index. If we take a look at market internals here, we had lots of really steepening negative numbers here in the number of stocks hitting 52-week highs minus those hitting new 52-week lows. And you can certainly see a bright spot here on Friday. Now, of course, I record this video quickly after the close, so I don't have the final numbers. So this might not be positive. This could be still negative. This is sort of a guesstimate I always have to pull here on the Friday data, but regardless, there should have been a big improvement on Friday, and this could have been some type of washout number here in terms of the early week numbers here. Minus 770 on Thursday. That's a big negative number. That's a good washout number in terms of stocks hitting new lows. AD line, you can see, ended up negative on the week. Percentage of stocks over a 20 SMA here, 41.18. Let's take a look at this chart here. So this is again the 52-week highs minus the lows summed up over the last 30 sessions and plotted here. And basically you can see again just very steep or just continued downtrend. And we made some lows here on Thursday. And again, we potentially are starting to flatline here. And again, this goes back to some of the statements we had last week where things are so bad that they might just be good enough to bounce and to rally. When sentiment really turns in lots of places across enough people, then certainly that can lead to the boat sort of tipping to the other side. If we take a look at sector performance here, we did get lots in the green. Healthcare was the top of the list here, 2.7%. Real estate, second spot. Utilities in the third spot. So still a little bit defensive, but regardless, we still had 7 sectors here, 8 sectors in the green. And on the downside, we had consumer discretionary, we had financials, and we had consumer staples, the only 3 finishing negative. In terms of correlations, so this was pretty notable here, of course, now. So with VIX, that spent, a few days above 30, and certainly lots of volatility out there. There's lots of bright green and bright red on this correlation table, which implies that there are strong correlations or strong inverse correlations happening here. And what you can see basically is that all the equity markets are essentially trading in lockstep with one another. There's not much divergence here. There's some divergence in terms of magnitude move, but everything is really moving in lockstep. And then take a look at gold, silver, the dollar, and oil. All of these have very steep negative inverse correlations. And that is to say, dollar's gain or gold's gain is equity markets losses. That's been the relationship. And again, I should remind everyone, these are just 10-day numbers. So these are very, very, very short. So it just again helps illustrate the flow of capital, where things are moving, what's moving, and what is, heading in the other direction. So lots of bright green, lots of bright red over the past 2 weeks. Take a look at the volatility term structure. It's the VIX term structure. So we look out front month, 3 month, 6 month, 1 year, and you can see this week is the blue line. So we did see volatility come down a bit this week, but it's basically still just this pencil across the chart here. It's a straight horizontal line, which again does not suggest that we are in a bullish, healthy market environment, right? You tend to want to see starting down here and gradually working your way up. So this here still implies that there is lots of caution, there's lots of worry, there's lots of concern, of course, for arguably very good reasons. And that still remains the case today, this week, very similar to last week. Interest rates, so they were up marginally across the board today, or this week, I should say. They were up pretty gradually, nothing too big, but still managed to rise a bit. If we look at the credit markets here, so J&K specifically, up almost 1%. That's a very encouraging number. You can see investment grade bonds are still down a bit, but J&K certainly holding up well. We're going to talk more about that later in this video. And last but not least, dollar and commodities. So dollar index was up this week. Gold ended up down. So it had this initial, it was basically moving exactly inverse to equity markets. So while that fear hit on Thursday when we got the the reality of what Russia was doing over there, we saw gold really pop and gap up on Thursday, and then it proceeded to sell off while equity markets proceeded to rally. So that was basically a good start. Week finish for gold. Silver up 1.27%. Bitcoin was up this week 5.5%. And you can see, generally speaking, commodities here were kind of a mixed bag, but oil, natural gas still managed higher. So if we take a look at the report card this week, we got 2 check marks here. So we had equity market performance, just generally speaking, credit market performance held in there, give it a solid C for the report card. Obviously the technicals, the short-term nature here, there was much more on the positive side. We'll talk about that in just a second here in part 2. And if we look at our trading system, so lots of green here, lots of exposure. So remember last week we basically had flat to very little exposure, and you can see both of our trading systems went aggressively sort of buying really on Thursday. It was Thursday's action here, which prompted lots of buying on these two trading systems. If we look at our shorter term one, Lamerick here, this is where it really, started attacking the market, and certainly seeing lots and lots of those bets pay off. It is currently 72% invested. I haven't looked at the orders for Monday, so this will probably be, I would guess, selling some things on Monday. So I don't know that we're gonna sit with this, but currently as of Friday close, we're going into the weekend with 71% invested. Merlin here again did some buying as well. Got some stopped out of some positions, did some buying, so changed hands a little bit, but 85% here. Again, this is not all equities. Part of this is fixed income. It is treasuries. So it is not as aggressive here. This is our longer term system, not as aggressive as this suggests, but it did do, on the margin, some buying this week as well. So those are our two trading algorithms. We send out trade reports. We talk about them daily. If you want to learn more about them, click that link appearing in the top right-hand corner. Sets you up for a 1-day trial, 14-day trial, $1, and we'll teach you a lot more about how they operate. So check that link out if these are something that you think you can benefit from. And with that, we'll be back in just a moment here with part 2. All right, we are back here. We've got TC 2000 open. We're looking at our equity market grid. This grid here has the S&P in the top left, Nasdaq top right, Russell bottom left, and international stocks minus the United States in the bottom right. The multicolored dots, they're a custom smart trend filter we've developed for TC 2000. If you're a TC 2000 user or a TradingView user, we have this indicator. It's available for our download on our website. It is a premium indicator, so that does cost money, but you can get this on your platforms, and it measures price and volume and helps us determine trend and trend strength. So first, in the top left here, we're looking at the weekly chart of the S&P 500, and we finally got a sell signal here. This was the last stubborn market here that was not turning down in terms of the U.S. markets. We had S&P 500 finally producing that sell signal. Of course, this is a weekly time frame. It's a longer term time frame. It's been sitting in this chop zone, so finally, turned down. Nasdaq, again, this is the now sixth week in a row, 5th week in a row down here for Nasdaq, and that continues to be the case. Nothing new there. The Russell 2000, same thing, continues down as well. Sell signal on this weekly time frame. But let's go to the daily chart, right? Let's go to the tighter action here, and again, you can see these daily trends all rolled over previously many weeks ago. So in the S&P 500, the first sell signal really was produced on January 10th. So that was the first time we got our sell signal in the S&P 500. That alone could have kind of got you to maybe sidestep some of this action, reduce exposure, put on hedges, et cetera, et cetera. Since then, it has been only negative to neutral, and it's had a few attempts to get over this smart trend filter. It hangs in there for a couple of days, but then ultimately fails and rolls back over. We'll see if this time's different. Still in a sell signal, still, kind of kissing the trend filter right now as of Friday's close. So we'll see if this behavior can start to change, but still suggesting some trouble. Same thing here for Nasdaq. This one ended up rolling over and producing its sell signal on Friday, the 7th of January, and there's been no real change here from this model. The Russell 2000's definitely been trying to show some signs of strength here and trying to get back up its daily trend. So remember, this one turned over way earlier, back in like December, but then it's more recently starting to try and stabilize a bit. So that's kind of the action there in the short term. Let's get to some of the candlestick analysis here. Let's look at some horizontal levels, some supply, demand, and price action specifically. So we've really been keying off of this grid here, this layout here. We've been keeping things pretty simple, and we had effectively this 2-zone support and resistance area to pay attention to. We had the level down here around 4,300, and then we had the level up here around 4,550 all the way up to 4,600. That was the real sort of simplified playground that we were in, and we've been talking about this over the past few weeks. Now, of course, what happened this week was on Wednesday, we started to challenge and break down from the bottom end of this range, the prior support. So really, if you were to simplify it, this nice chop zone, this initial thrust down here in the market in the end of January, this created our sort of our low point, our low pivot, and that's what we were really paying attention to. Wednesday of this week, we broke below it, and that was your sign to say, okay, let's brace for some volatility. Now, we did get some volatility on the next market open. This was, of course, when the news broke on Russia. And so we had this initial leg lower. Markets were digesting news. We opened the day down 2.5% or so. But from this point, we basically saw nothing but a rally. We tried to push lower real quickly and then reversed course and proceeded to sort of rally throughout the session. So what we ended up getting here was this kind of false breakdown, and we ended up closing the day right back into this 42.90, 42.87 area. And so that was your first sort of clue here that maybe the market isn't so comfortable staying below this 4,300 zone, given the fact that we just rallied throughout the day on seemingly, or undeniably very negative news. And then, Friday comes along and we start the session a little higher and then again sort of proceed to rally and put in this follow through day to the upside. So when we take a step back and now we look at where we are and what we did here this week, we essentially put in this false breakdown, this capitulative sort of move down here, and we aggressively rebounded back over this 42.80, 42.90 zone. So when I look at this and when I was going through the charts here, even on Thursday's close, there were so many reversals out there taking place in the market. And, the big question is, of course, is it going to get the follow through and can it stick? And going into the weekend now, we see that, the answer is seemingly yes. So when I look at this as a short-term trader, I would be constructive on this bottoming type action. I do not know if it's the low, right? I'm not going to never try and make these big grand, futuristic takes on whether or not the low is in. But I certainly think a low is in, and as long as the market can stay over, let's call it 42.80 or, this general area here, then I think it's a pretty constructive look right now heading into next week and early March. And so we're back into this old zone. And so I don't see any reason why the market can't eventually get back up to this 4,600 zone, 45.50, 4,600 zone, and start challenging those old highs, right? And again, that's not a prediction either, and I'm not saying that has to happen, but it would not be a surprise to me at this point to see kind of this squeeze take place and move back up to this zone. So that's, really the big takeaway here is it seems like we got a good washout going on. Markets were oversold. We've got, more extreme headlines coming out, and then we got a rally and then a follow through day to the upside. Now, one last piece here is we did cover a lot of ground. I mean, in one session from low to high, the S&P 500 is up 6.5% from its lows to where it closed today in 2 sessions. So, it has covered ground. Let's make sure we're aware of that. But, a move back up into this old range, like I say, does not seem unreasonable. So that really covers up the S&P 500. If we look at the Russell 2000, this was sort of the last grid we were looking at here. We had this, kind of retest of the old breakdown zone. We broke down from it, but we didn't get very far, right? We barely tested or tagged or undercut slightly the lows here from January. And then look at this big, again, just rally from the close and strong close bar. And then again, more follow through. So the Russell putting in that type of look, and the same thing with the Qs. Take a look at this action here. We talked about, again, this similar level, 340. We closed below it on Wednesday, and then take a look at what happened on Thursday, a puke kind of open and then strong close and follow through. So all of these trends are still down. right? 2 days are not changing these trends. So we still have a series of lower lows and lower highs in development. So it is, again, just always going to come down to your time frame, your risk tolerance, what you're trying to achieve here. The volatility is great for short-term traders. If you're longer term, then you probably still need more action to sort of convince you. If you go to a weekly chart, again, you've got this nice looking hammer reversal taking place at 4,300 at a prior support level, but you haven't quite, started to break out, obviously, just yet. Last comment here is Bollinger Bands. Again, in terms of just oversold signals and buy signals, right? We closed below the lower 2 and 20 Bollinger Band on Wednesday, and then we opened way below it on Thursday. Again, that just gives you an indication of where the market was on a relative sort of basis and what led to some of this snapback here. So that, I think, covers, a good mix here on the market. Again, I think you still need to manage risk. You still need to be careful. We're still in a heightened volatility spot. We still have headline risk. We still have geopolitical risk with lots of things going on. So by all means, it is not a easy buy here or, sit back and just play this bounce. You're still going to have to manage risk. You're still going to have to be quick on your feet. And if we start to roll over in a meaningful way, then you need to be able to change course. So that is really kind of the summary there. If we take a look at some other markets, I mean, again, gold, take a look at, again, this action here. So, 3 weeks up in a row for gold, couldn't make it 4. We got all the way up to around 182 in GLD and then put in this reversal. So this looks like maybe it needs some time to cool off and digest for a little while. You can see, of course, oil is a little similar, but maybe a little less dramatic. This could be, the sign of finally the top is in here for USO. But again, it might just need a little bit more time. Big volume coming in over the past week. And then if we look at like treasuries, they're still struggling to try and catch a low here. It does seems like they're trying to bottom out here as well, but it's still just, still just needs some more time and more convincing here. TLT, not the prettiest looking weekly close here, but, after the kind of back-to-back hammers the last 2 weeks, maybe that low is sort of in the short term. So that, I think, covers everything. Let's quickly take a look at some of our sector and industry analysis. So nothing on the bearish side because everything pretty much reversed course. If we look on the upside here, weekly chart, for instance, Aerospace and Defense, strong volume coming in, starting to clear back above some of these recent highs in here. We've got department stores, again, new highs. Increased volume here and trying to close above some recent highs. We've got gambling, which put in a nice bullish engulfing week here. This has been beaten up as of recently. Good volume coming in. Oil and gas, E&P, so heavy volume back up towards its highs. Software infrastructure, big outside reversal bar, heavy volume coming in. Steel, looking good too as this consolidated sideways and really stayed very firm over the past 6 months or so. Last but not least, utilities, regulated gas specifically, going for a breakout here. And then we had, just generally speaking, XLK, which is a place actually where a Merlin trading system ended up buying this week. And we had SMH put in, again, a good high volume reversal as well. So that's it. That's what I got for this week. Lots of action out there. Again, hopefully, if you had a tough week or it's a challenging week, reflect, take a pause, do some homework on some of the past charts and see what you can do better for next time. That's the name of the game, I think. So that's it for me. As always, if you like the videos, please do subscribe, and you can always check back here on Fridays, also on our website, thetraderisk.com. Don't forget, if you want any of those scans or the smart trend filter, you can find that on our website as well. So that's it for me. Enjoy the weekend. We'll see you back here next week.